Two former White House chiefs of staff say President Trump's Twitter habit has been distracting at best and destructive at worst. And if he were their boss, they would tell him to stop. That's according to the Washington Post. Josh Bolton, who was chief of staff to President George W. Bush, calls Mr. Trump's tweets, quote, political gasoline. Dennis McDonough, who was President Obama's chief of staff, says the president's tweets have the ability to, quote, walk back a lot of hard-fought progress. Vice President Pence held talks in Seoul with South Korean President Moon Jae-in. President Moon thanked the United States for its support and took the opportunity to highlight the visit of the North Korean officials to the Games, calling them the Olympic Games of Peace. President Moon's spokesman later confirmed that Moon plans to meet North Korean leader Kim Jong-un's sister and other senior North Korean officials who are traveling to the South on Friday for the Winter Olympics in Pyeongchang. Eagles fans are releasing nearly 60 years of frustration today as the city honors the Super Bowl champs. You're looking at a live picture from downtown Philadelphia. The players are riding atop trucks and double-decker buses through the streets of downtown, where some estimates put the crowd at 2 million. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Mark Crumpton. This is Bloomberg. David?
Thanks so much, Mark. We, of course, are following the markets, which are down a little more than 2% right now, down more than 8% since their peak back on January 26th. But we're also following the government shutdown deadline, which comes up at midnight tonight. The budget deal, working its way through Congress today, may take care of funding the government for the next 2 years, but it's not going to address the plight of the so-called dreamers, people who came to this country without documentation when they were just children. Representative Ruben Gallego has made it a priority to address this problem of the dreamers. A son of immigrants, Representative Gallego served as a United States Marine in Iraq, which led him to seek elective office. We welcome Representative Gallego now from Capitol Hill. Welcome, Representative. Good to have you here.
Thank you for having me.
Let's start with this budget deal right now. As far as you can tell, is this going to pass the House later today, and will you vote for it?
I certainly will not be voting for it. Whether it passes the House is determined. We have to wait to see. We're going to need essentially most of the Republicans to vote for it, because I think at this point you're going to have the majority of Democrats not voting for this. So it really does depend at this point on the whipping power of Paul Ryan. And I hope the Democrats will not join in supporting this bill.
Well, what about the whipping power of Nancy Pelosi? Because she took to the floor and talked for more than 8 hours yesterday, saying we are not going to pass anything if we don't have the immigration issue addressed. It appears right now like that's not going to be addressed. Why will she not be able to get her Democrats to stay with her?
I think she will actually get a majority of the Democrats to stay with her. We are a very diverse party from different parts of the country. We will not get 100% of our Democrats to stick with us. We certainly will have a majority. And the leader Pelosi, from what I understand, is whipping against the bill, as well as the Congressional Hispanic Caucus and other caucuses are making sure that we all stand against this bill because, again, the deal was that we were supposed to deal with dreamers. That was the deal that was struck in September by President Trump, and then they moved the goalposts, and now we're at the end of the goalposts. It's time to come to reality, time to come in for a deal. If you get the votes without us to pass this budget, then that's great. Then go ahead and do that. But if you're going to need our votes, then you should come and deal with us and actually come to a solution when it comes to the DREAM Act.
Congressman, you're in a unique position. As David mentioned, you're a United States Marine. You served in Iraq, but you're also a Democrat who wants to see more domestic spending. This budget deal has both military spending, domestic spending. It would be a big victory for the Democrats. Why not take this win? And you also have time for immigration later on.
We have time for immigration, but the question is what kind of bill is that going to look like? Right now, we have 800,000 people hanging on the vine, people that have families, that have businesses. If you want to talk about military, 10,000 of those dreamers are veterans, including obviously the veterans' families. And so, you just can't separate it that easily. And we would rather have a better outcome now when we could all tie it all together. At some point, if we don't have this and we have to deal with this later, I think the Republicans are not going to deal with us in good faith. They're going to try to extract a very heavy price in order for us to save and protect many of these dreamers. So we'd rather deal with this right now. Also, lastly, the talk that these Republicans have about how they're all pro-military is just totally bogus. They have been the cause of basically the deterioration of this military because they're the ones that enforce the sequestration law for so many years. So so many years when all they had to do was, in fact, work with us to actually lift the caps and increase defense spending plus domestic spending. It is because of these so-called fiscal hawks that now we have to throw so much money in to undo essentially what was a Republican idea with sequestration, specifically led by the Freedom Caucus, who are, again, being the obstructionists when it comes to funding of this government. This bill can pass entirely with Republicans if the Republicans knew how to govern. But Paul Ryan is not a good speaker. He hasn't been a good speaker. He does not know how to govern, so he essentially has to continue to do these stopgap measures and ends up, relying on Democrats to help him put him over the top.
Congressman, Speaker Ryan, talking about Speaker Ryan, has re-emphasized his commitment on solving the immigration issue. First, take a listen.
I know that there is a real commitment to solving the DACA challenge in both political parties. That's a commitment that I share. To anyone who doubts my intention to solve this problem and bring up a DACA and immigration reform bill, do not. We will bring a solution to the floor, one that the president will sign.
What would you need to see in order to be able to support the deal?
An actual vote. Look, I know Speaker Ryan is lying because his lips are moving. He has said this before for so many years. He actually sat down and held hands with a crying woman in his district a year ago saying, don't worry, we will not deport you, we will take care of you. And since then, he's refused to meet with her. He's refused to meet with the Catholic Archdiocese of Milwaukee and asking him for a solution to the DREAM Act. Speaker Ryan has shown no leadership on this, and if he thinks that somehow just introducing a bill that's essentially going to be a deportation bill and call it an immigration reform bill, and that's going to somehow satisfy us, he is incorrect. So he needs to get working, and he hasn't proven that he hasn't proven that he's a man of his word.
So finally, Congressman, we have to talk about these markets, which are down again today across the board, more than 2% right now in the Dow as we look at it. And there are quite a few commentators who think that this is attributable, at least in part, to what's going on right up there in Capitol Hill, because people are very concerned that it appears, at least to the outside world, that the answer to every problem is to spend more money, all for good causes, but money that we don't have that we have to borrow. How concerned are you? How concerned are your colleagues about the effects on the economy and therefore on workers, on a lot of your constituents, of what's going on up on Capitol Hill?
Of course we're concerned, but at the same time, you can't have it both ways. For those people that are concerned about how we're spending money, at the same time, they shouldn't be demanding these tax cuts that are putting us deeper and deeper into the hole, including the corporate world. And so this is a Republican problem. They took out, at a minimum, a $1.5 trillion loan from our citizens and from the future, and now are going to turn around and spend more than $1.5 trillion in future spending, whether it's this, the border wall, or other areas. So, at some point, while I am very worried, I'm also not going to start starving the beast and also denying a lot of the very important social programs we need for this country, especially working people, to advance, when my colleagues seem to have no care in the world when they were trying to cut corporate taxes.
Congressman, thank you so much for your time. Congressman Ruben Gallego, Democrat of Arizona. Still ahead, we're keeping a close eye on the markets. Take a look at the S&P 500 right now. We are seeing declines of 1.6%. 10 out of 11 sectors are in the red today. The S&P 500 has wiped out $1 trillion in market cap so far this week. Live from New York, this is Bloomberg.
Toros como negocio, espectáculo y cultura. Tiempo de Toros. Con Rafael Cue, viernes, 9 de la noche. Retransmisión, sábado, 9 de la mañana. Porque reconoces lo importante, el Financiero Bloomberg.
in the markets accelerating in the afternoon session. The Dow down more than 2% and losing more than 500 points. The S&P 500 is also down 10 sectors out of 11 in the red, while the Nasdaq is also losing 1.9%. Joining us is Mike Regan of Bloomberg Markets Live. So what was supposed to be a healthy correction continues.
Yes, yeah, healthy correction that I think is making a lot of people sick to their stomachs at the moment. In a way, what we're seeing is sort of following the playbook as far as spasms of volatility like this that we've seen in, at least in the computerized age of the stock market. It's very often, if you look at, say, the flash crash of 2010, or when we had a really volatile market after the U.S. lost its credit rating in 2011, you'll see this massive crash that seems to come out of the blue after a little bit of weakness. Then you get a rebound, then you get more on the downside. And it's very often, you'll see the market test the lows of that crash. So, for example, the Monday low was tested today. We had an even lower low on Tuesday. So my gut sense is that the market's maybe going to want to test that too and see what people think, see where the traders' buy orders are.
Of course, investors are saying, where's the bottom? How far down can it go? And is that a matter of really there being over-exuberance, inflation of asset values because perhaps of monetary stimulus on the one hand, which is pretty static,
yeah.
Or is it because of a moving target because Congress keeps appropriating more and more money, which increases the deficit, which increases borrowing?
Yeah, absolutely. I mean, the yields are very much the story of today, and we've had, two Treasury auctions this week that, sort of the playbook would be, well, we've got a very volatile equity market. There will be this, move into safe haven assets like Treasury. But investors aren't really buying with both fists at these auctions. Two disappointing auctions, and yields are still elevated. So the interest rate risk, I think, is front and center of basically all investors' minds right now, especially when you don't see a drop back in yields after the volatility in stocks like we're seeing.
Yeah, that's exactly what we saw, because we saw some comeback in treasuries earlier, and then we had the 30-year treasury auction, and now yields are again gaining ground. So
right.
Are we going to see this vicious cycle just continue?
It's a great question. I don't think I would be confident in saying yes or no completely. But what we've seen so far is, yes, it hasn't been enough to push this safe haven trade in the treasuries like you might expect. So it goes to David's point about, we're blowing up the deficit at the same time that central banks are pulling back on stimulus, and inflation is picking up. It's a tricky time.
Mike Regan, thanks so much for being here. I'm going to give you a plug. Follow all this on M Live right now. If you're not watching us, you should be on M Live.
I should be typing right now.
Yes,
That's
right.
Healthy corrections making you sick to the stomach. Thank you so much. Let's get a quick check of the markets as we go, because the Dow continues to fall and the S&P 500 down 1.7%. Plenty more coming up. This is Bloomberg.
La economía mundial se enfrenta a cambios nunca antes vistos. El presidente de Bank of America conversa con David Weston sobre sus perspectivas de negocios. A Conversation with Brian Moynihan. Sábado, 9:30 de la noche. Porque reconoces lo importante, el Financiero Bloomberg. quién es quién en los negocios mundiales y todo lo que debes saber para la toma de decisiones financieras. Bloomberg Surveillance. Lunes a viernes, 3 de la mañana. Porque reconoces lo importante, el Financiero Bloomberg.
Again today, right across the board. Let's get the latest now from Abigail Doolittle.
Thanks, David. Well, we are certainly looking at a sell-off for the major averages. We have the Dow, S&P 500, and the NASDAQ all down sharply, as you can see, down about 2% or more. In fact, the three major averages now negative on the year. This is a continuation of what we have seen more recently. Last week, of course, we did have a big sell-off, the worst since early in 2016. If we take a look at a 5-day chart of the S&P 500, we can see where the selling pressure actually began, starting again last Friday. Last week, there was intraday volatility into a big sell-off on Friday, and then Monday happened. Of course, a historic day of volatility, a lower low on Tuesday morning. Speaking to the uncertainty, investors are jittery. They're not quite sure what's happening here. It almost feels as though the rally that we saw last year into January of this year, a game of musical chairs, and investors are scared that the music has stopped. They're scrambling for a chair. So now we see this volatility. All of this appears pretty bearish from a technical standpoint. We do have the Russell 2000. It did touch down onto its 200-day moving average, these other moving averages below the 100-day moving averages. That tells us that the intermediate term buyers are disappearing, the sellers really stepping in, and it feels somewhat orderly. This is not like the Black Monday in 2015. It's more similar to August and September of 2011, or even the dark days of 2008 and 2009 on a smaller level. What also stands out, these are very high quality companies. Microsoft, Amazon, JP Morgan, and Facebook. These are the top point laggards for the S&P 500, really dragging. The thing that stands out here on Tuesday, when we had that frenzied rally at the end of the day, when we had buy the dip activity, these were the names that were being snapped up, but they're now once again being sold off. So investors pretty nervous here about what's next, and unabatedly, as you would, throwing out the baby with the bathwater. One high quality company, though, that is about flat on the day. If we hop into the Bloomberg and take a look at Apple, Apple is about flat on the day, but this is a longer term chart. I've slavishly been watching this Apple chart. This is a roughly 3-month chart of Apple on an intraday basis. And of course, Apple put up that disappointing earnings report when the iPhone numbers disappointed. That was one of the triggers for the sell-off last week. It's not just the overbought conditions and rising rates, but that Apple report was disappointing, a big sell-off. The question here is this pattern on an intraday basis. It's something that could be called an intraday head and shoulders pattern. If it reverses higher, Apple will go much higher, because think, if Apple was not flat today, the sell-off would be much, much bigger. So it's important to see whether or not Apple can hold that last low. The broader chart may suggest no, but again, an important tell. And then finally, again, I just mentioned another source of pain beyond the overbought conditions in January, plus Apple and some other disappointing earnings reports. We do have a situation of repricing risk. This is the 210 spread. A big story last year was how we were having the yield curve flattening. It is now moving back out this year. Inflation expectations taking investors off guard. What's the real price of money now that the Fed is out of the way and that we do have rates rising, really pressuring the risk assets, and especially today, stocks with the sell-off that we're seeing, David and Sherry?
Yeah, Abigail, we saw that big U-turn in Treasury markets. Abigail Doolittle, thank you so much. Let's get a little bit more on the markets. As Abigail was telling us, we continue to see that sell-off deepen in the afternoon session. Joining us now to discuss by phone is Wheaton & Company Chief Global Strategist Michael Purvis. Michael, thank you so much for talking to us. When and where will we see the bottom as we continue to break major support levels?
So we're cracking right through the 100-day moving average right now. If we continue to sell through this, we'll probably get to the 200-day moving average in pretty short order. That's another 3.5% or so down from here. But I want to back up and just mention something that the fact that we are even holding the 100-day moving average through this massive volatility shift. And after being so heavily overextended just prior to the sell-off, just in January 26th, we were 2 standard deviations above the 100-day moving average, a near record. This kind of stuff really should be expected. Certainly psychologically, it feels ugly in your stomach, and we've all been sort of steeled to this extraordinarily low volatility, and a dip was something that happened on the way to get a cup of coffee, and you missed it when you got back to your desk. And this is more of a normal old-fashioned dip, but it doesn't necessarily mean that the bull run is over just because we're having sustained volatility.
The chart 4192 for our Bloomberg users, they can actually see that volatility, the daily price swings intraday, the S&P 500, NASDAQ, and the Dow spiking this week. Michael, are we seeing a new volatility regime where we're just going to see the end of low volatility, not the end of a bull market, but at least the end of low volatility?
Well, I would suggest this, that if rates and inflation continue to edge into a higher range, the idea of going back to 9 and 10 prints on the VIX is really pretty remote. We will see a higher floor on the VIX going forwards. And I think the real question that traders are trying to answer, and I'm certainly trying to answer, is, are we 2 feet into a regime shift here on rates and volatility and inflation, or are we just sort of one toe in? And how resilient is that? How resilient is the old regime if in fact, we do get a real Treasury, inflation moving up and so forth? That's really the question right now. But I think, I'm not seeing enough signals from the markets or from the economic data suggesting that we really are in that much of a different place than we were a couple of months ago.
Well, Michael, let's go to exactly that point. I mean, because I think a lot of people are concerned, is this really a stock market phenomenon with a little bit of treasuries, or might this spread into the basic economy? What will you be looking at to determine that? What are things like high-yield spreads looking like? Are there other indications that this might be spreading into other asset classes?
Well, it's very interesting. I mean, let's just start with realized correlation. Realized correlation across stocks increases with the VIX and goes down with the VIX. What's really interesting about this move, David, is that the spike in realized correlation has been extremely tepid here, and certainly relative to prior VIX spikes. And you can measure it like the realized correlation relative to the VIX ratio is actually at lifetime lows here, right? So that kind of suggests that actually for all of the sort of ugly feelings that you feel in your stomach right now about the market and the bottom falling out, that there is some order to this sell-off, and that the correlation, there is a lot of discrimination about what stocks and sectors are getting sold and what are outperformers. And I think that's a significant metric to keep your eye on here as we go through this.
And Michael, as you look at it, do you have any sense of how much of this really is a matter of the economy and the markets on the one hand, or really Washington on the other? Is it just a coincidence that we are going through some of the things we're going through in Washington right now when this is happening, or might there be a connection, particularly as the markets and investors see Congress apparently at least willing to take on more and more debt, more and more deficit spending?
Yeah, well, I mean, I would say this, David, that regarding the short-term issues on spending and all that, and a deal here, that's relative. That's kind of noise here. But you're touching on a very important issue, which is that post the tax bill, we are talking about $1 trillion, give or take, of incremental budget deficit, and I think that is one of the things that is going to maybe make both the dollar and rates potentially be perceived in a different way than they had before. That's a big number, and what's very interesting to see is how the dollar, despite these higher rates, higher nominal rates, higher real rates, the dollar bid is really not materializing here. And I think there's the potential for the second half of the year to see higher rates with a weaker dollar, which is really not something that the White House or a lot of people would want to see. That's a condition which is something that we saw play out a little bit in the UK after Brexit as well. So it's definitely something to keep your eye on here.
What about liquidity? How much cash is on the sidelines to be able to support the markets?
Well, it's a great point, Sherry. The market, one of the beautiful things about this rally over the last 6 years was that it was the most hated rally. And that the more hatred there was, the more the market rally persisted, right? And then finally we got into this, it seemed like retail was jumping in with both feet here. And there's certainly some anecdotes about hedge funds, kind of getting pretty bulled up, in mid-January. There. So, arguably there's certainly not the cash levels on the sidelines that we had seen during, throughout the last 4 or 5 years of this rally here. And that would certainly drive more volatility. And certainly, I think, many participants just expected, this dip would be, a dip was expected, but it would be a relatively benign one here. And that certainly could be one of those exacerbating factors, as you were just talking about, the intermediate buyers, or maybe it was Abigail saying that the intermediate buyers don't seem to be coming in today. And that could be, one of the factors that people a lot of people just caught over their skis here.
So Michael, finally, tomorrow's Friday, as you might have noticed. We're heading into a weekend. You're a student of these things. What are the things you're going to be looking at your dashboard to try to sort out whether, as you said, we're 2 feet into a regime change or something less threatening?
Well, a few things. First of all, keep your eye on the MOVE index. That's Treasury volatility, seeing if that, keeps moving higher, and if 10 and 30-year bonds, really keep spiking up higher into the Friday. If that happens in the morning, I'm going to be very surprised to see if equities can really catch a bid against that on a Friday. People don't want to wake up on Monday morning and see bonds at 1% and the 10-year Treasury yield at 3%, and then we're not one toe into a regime change, but maybe 3 or 4 toes in, and that. And again, I think so on the other hand, if Treasury stabilize and some of the overnight action in China stabilizes, I think you're going to start seeing, you could see a firming here. But again, I think we're in one of these zones in the market where I think there's going to be there's naturally caution ahead of the weekend here, and I think it's going to be hard to see the SPX put in a fantastic showing tomorrow, given the price action we're seeing today.
Already $1 trillion wiped out of the S&P 500 this week. Michael, thank you so much for your time. Michael Purvis, Chief Global Strategist at Wheaton Company. Take a look at what the markets are doing as we're talking. Volatility continues to rise. The VIX, after curbing gains for the last 2 sessions, is back up again above that 30 level. Volatility in the bonds markets is also up, highest since April. And remember, the 10-year yield was coming down a little bit during the intraday session, is back up again after that 30-year Treasury auction was a bit weaker than expected. We'll have plenty more coming up. This is Bloomberg. This is Bloomberg Markets Balance of Power. I'm Sherry Yan.
And I'm David Weston. Let's get to the headlines with Bloomberg First Word News from Mark Crumpton. Mark.
David, Sherry, House Minority Leader Nancy Pelosi isn't resting after yesterday's 8-hour marathon speech on the House floor. At a press conference today with fellow Democratic lawmakers, Pelosi reiterated her party's commitment to passing immigration reform, and she explained her nearly 8.5-hour-long address.
I didn't go out there to be there 8 hours, but when I asked members for their statements from their dreamers, we were flooded with them. And what it accomplished was it again reminded the American people what our commitment is to our values.
When asked about the bipartisan spending bill currently under consideration in the Senate, Pelosi said, quote, "I think it's a good bill," but added that she won't support it unless demands on immigration policy are met. President Trump has nominated California tax attorney Charles Rettig to lead the Internal Revenue Service as it institutes the Republican tax overhaul. The job comes with a sensitive task, overseeing an audit of the president's tax returns. Mr. Trump departed from roughly 40 years of tradition of presidential candidates by refusing to release his returns during the 2016 campaign. Iraqi security forces continued their anti-militant operations today. The operation is aimed at dislodging insurgent cells, some of which are believed to be remnants of Islamic State. Major operations against the extremists ended last year, but the Iraqi government has said the threat from militants remains serious. Israeli Prime Minister Benjamin Netanyahu is brushing aside accusations of wrongdoing, which are the subject of several corruption probes. Israeli media have said the investigations are likely to result in indictments, but in a video posted on his Facebook page today, the Prime Minister insisted the probes will find nothing. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Mark Crumpton. This is Bloomberg. David?
Thanks so much, Mark. We are, of course, continuing to follow the markets. They're coming off some of their lows right at the moment, although they are still down across the board more than 1%. Now we turn to the White House. Yesterday afternoon, the White House Staff Secretary Rob Porter left his job after 2 ex-wives accused him of domestic violence. Now the question of when White House officials, and particularly Chief of Staff John Kelly, first learned of these allegations, and whether General Kelly continued to defend his subordinate even after hearing about the problem. To take us through it, we welcome now from Washington, our White House editor, Alex Wayne. So, Alex, explain to me why this is an important subject, apart from what it means for Mr. Porter and his ex-wives. Well, why is it an important subject for the White House, and particularly for General Kelly?
Staff Secretary really understates the importance of this guy's job. He's a very high-ranking official in the White House. He handled a lot of classified material. He essentially put his hands on every piece of paper that went in or out of the White House. He also sat in on meetings in which classified material was discussed. And he apparently never had a permanent security clearance, probably because of these allegations against him. The question now is who knew what in the White House before these published reports on the domestic violence allegations, and what they did about it. Our reporting indicates that the president was never informed of the trouble in Rob Porter's background before he saw or heard of the Daily Mail report on Tuesday.
Alex, but this is not the first time that we hear about problems with some of the personnel, whether it was in the White House or as the campaign progressed. So what does this tell you about this administration's vetting process?
It's not great. It's pretty well known that a lot of other officials were kicked out of the White House as their security clearance investigations were proceeding for really lesser problems. There were issues where people didn't fully disclose their sources of income or had some drug use in their history, and for whatever reason couldn't get a security clearance, and so they had to leave the White House early in the president's tenure. That's not particularly unusual for a new president, by the way. But in this case, in Rob Porter's case, he was allowed to stick around, even though there were apparently some very serious allegations in his history, and so that's what we're asking now. Who let him stay there and why?
Well, exactly, Alex, and this is what I don't understand. As I understand it from the Bloomberg reporting, there were basically two people who saw all the documents being given to the President of the United States, and they were the Chief of Staff, General Kelly, and Rob Porter. Those are the only two people who saw all of these documents, and yet he could do that without a proper security clearance. Why is that even lawful? I mean, the President can declassify things if he wants, but I don't understand he's declassified all the documents he was being given.
Yeah. Well, you know, security clearances with regard to White House officials, especially top White House officials, is a little bit of a gray territory because the president is in charge of the executive branch. The president essentially decides who gets security clearances or doesn't. Donald Trump effectively can grant a security clearance to anybody he wants. And so Rob Porter had an interim clearance while his official permanent clearance was underway, while the FBI was conducting a background check. He had been granted an interim clearance, and so effectively the president himself was allowing Rob Porter to handle these classified materials and be in these meetings.
Alex, thank you so much for that insight. And that was Bloomberg's White House editor, Alex Wayne.
And coming up, another day, another impending shutdown down in Washington. We'll get a check on how the budget plan is faring on Capitol Hill next. This is Bloomberg.
El 2018 ya está en el Financiero Bloomberg. María Scherer, Kiren Miret y Esteban Illades tienen los temas clave respecto a campañas, partidos y los presidenciables. Urna tras otra, martes 9:30 de la noche. Porque reconoces lo importante, el Financiero Bloomberg.
That sell-off in the markets. The losses are paring back a little bit right now. The Dow down 1.7%, but still, as you can see, down more than 400 points. Every sector on the Dow is in the red. The S&P 500 also down 1.5%, wiping out about $1 trillion in market cap this week alone. The Nasdaq down 1.6%. One stock that's not doing too bad, though, Twitter, after seeing its first real profit, is still surging 17%. Still, everybody else seems to be taking a hit.
Okay, even as the sell-off continues, not everybody is all that concerned. Here's what New York Fed President Bill Dudley told Bloomberg earlier.
The implications for the economic outlook are very marginal, and so probably not going to change our thinking about the economic outlook. If it were to go on much further, and be much more persistent, then it could start to affect household and business spending behavior, and then that could actually start to influence the economic outlook. But so far, I'd say this is small potatoes.
That was New York Fed President Bill Dudley. We want to turn now back to Capitol Hill, where, of course, they are working against a deadline of midnight tonight to keep the government open. We have bills in the Senate and the House that are due to be voted on today. And so we turn to Kevin Cirilli, our chief Washington correspondent, to bring us up to speed. Where are they on the voting, Kevin?
Hey, David. So over in the Senate, we're anticipating some type of vote sometime this afternoon. There isn't a specific time yet. They haven't moved on the procedural vote in order to get to that standpoint. But we should note that here in the House of Representatives, where, of course, the story has been focused because of the vocal critics of this, most notably the House Freedom Caucus, they're not going to be able to stop this. And it is very likely, almost certain, to pass here in the House of Representatives before the deadline runs out at midnight. Now, of course, we should also note that over in the Senate, we've had potential 2020 Democratic candidates again voting, saying that they are going to vote against this. They are not enough to derail it, but a lot of political posturing going on right now. This, of course, if you're outside of Washington, I would argue that the biggest takeaway is that this provides some type of economic certainty, gets rid of the risk of other potential shutdowns. It's a 2-year extension. Also deals with the debt limit and raising the debt limit, avoiding another monumental fight that could have been right around the corners. What it doesn't touch is DACA and immigration.
Exactly. I was going there. It does not deal at all with immigration. So what happens to that issue?
Well, March 5th, Sherry, and look, we just don't know right now what exactly the timing is going to be on what's known as floor time, when they're really going to focus on this in both chambers. Now, there was some signal coming earlier today from House Speaker Paul Ryan about DACA. He actually issued some praise for his colleague, Minority Leader Nancy Pelosi, after her epic 8.5-hour floor speech. Not technically a filibuster, but for all intents and purposes had the appearance of one regarding DACA. He said that he was going to guarantee floor time on DACA. When that is, when that happens, we just don't know right now.
So, Kevin, finally, if this goes through, as it appears it's likely to now, is this a victory for the president because he basically gets his funding, particularly for his military, without having to fight about the wall right now? And is also a victory for bipartisanship because both Democrats and Republicans have come together.
Yeah, there's no question that this is definitely a bipartisan deal. Even Minority Leader Pelosi saying today that while she's against it because it doesn't include DACA, that she called it a quote-unquote good deal. Even Minority Leader Schumer over in the Senate calling it a rare moment of bipartisanship. Look, so there's that element of this, David. But as you know, the other element of this is that President Trump has really not been at the negotiation table on this longer-term deal. So I'll leave it to folks watching to peruse through what that means about the president and the White House's involvement on this.
Lots of people have pointed that out. Kevin Cerelli, thank you so much, our chief Washington correspondent. A busy day ahead for you. Take a look at the markets because we continue to see the sell-off, but paring back some of those losses. The S&P 500 down 1.4%. We're seeing industrials and consumer discretionary stocks leading the decline.
And a quick reminder, you can go to your terminal and watch us all on TV Go. Live from New York, this is Bloomberg.
Mauricio Mejía tiene la información más oportuna para la sobremesa, cultura, espectáculos y deportes. Expreso doble, lunes a viernes. Primera emisión, 3:45 de la tarde. Segunda emisión, 6:45 de la tarde. Porque reconoces lo importante, el Financiero Bloomberg.
Bienvenidos al Financiero Bloomberg. Yo soy Víctor Piz. Estamos a instantes de conocer la decisión de política monetaria del Banco de México, la primera del año. La mayoría de analistas consultados por Bloomberg espera un incremento en la tasa de interés de referencia de 25 puntos base a 7.50%. La publicación esta mañana del dato de inflación para enero de 5.55% anual, por debajo del 6.77% en diciembre pasado, no modificó la expectativa del consenso. A diferencia de la reunión de diciembre, en esta ocasión la Junta de Gobierno estará completa luego de la incorporación de Irene Espinosa como subgobernadora. En unos momentos conoceremos si la decisión de política monetaria se tomó por consenso o por mayoría de votos de los miembros de la Junta. Es un hecho, ya lo vemos en pantalla, ha subido la tasa de interés de referencia del Banco de México, 7.50%, lo vemos en la terminal Bloomberg, 25 puntos base. Banco de México hace bueno el pronóstico del mercado, ya es un hecho, la tasa de interés a partir de hoy, de esta tarde, sube a 7.5%. Estamos viendo también del lado izquierdo la terminal de Bloomberg con la imagen del tipo de cambio. El tipo de cambio había estado muy volátil en la mañana, llegó a bajar a niveles de 18 pesos con 70 centavos, luego se presionó, llegó a 18 con 95 y en estos momentos veo que la reacción del tipo de cambio es estable. Voy a dar también lectura en unos momentos al comunicado de Banco de México para conocer en qué términos se ha dado la decisión del Banco de México, si fue por consenso o por mayoría de votos. Aquí la vamos a tener. Pero bueno, ya es un hecho, la Junta de Gobierno del Banco de México ha decidido aumentar en 25 puntos base el objetivo de la tasa de interés interbancaria a nivel de 7.5% y efectivamente la decisión ha sido unánime. Dice la Junta, voy a dar lectura a la parte final del comunicado, dice... la Junta de Gobierno ha decidido por unanimidad, se confirma, es una decisión unánime, aumentar el objetivo para la tasa de interés interbancaria a un día en 25 puntos base a un nivel de 7.5%. En la parte final, que es lo más relevante del comunicado, dice que la Junta continuará vigilando muy de cerca la evolución de la inflación respecto a la trayectoria prevista, considerando el horizonte en el que opera la política monetaria, así como la información disponible de todos los determinantes de inflación y sus expectativas de mediano y largo plazo, incluyendo el traspaso potencial de las variaciones del tipo de cambio a los precios, la posición monetaria relativa entre México y Estados Unidos, es decir, el diferencial de tasas de interés, y la evolución de las condiciones de holgura en la economía, ante la presencia de factores que por su naturaleza impliquen un riesgo para la inflación y sus expectativas. De ser necesario, la política monetaria actuará de manera oportuna y firme para fortalecer el anclaje de las expectativas de inflación de mediano y largo plazo y lograr la convergencia de esta a su objetivo de 3%. Retomamos la pantalla, la terminal Bloomberg, donde tenemos la evolución del tipo de cambio. Estamos viendo que se está moviendo con volatilidad a la reacción del tipo de cambio. Aquí la vemos, las cotizaciones están moviéndose con rapidez, pero bueno, en un rango en torno a 18 pesos con 85 centavos en este momento, la reacción que hay en el tipo de cambio. Vamos a ver otros elementos del comunicado del Banco de México, sobre todo lo que tiene que ver con el balance de riesgos para la inflación y también para el crecimiento. Pero bueno, habrá que ver también cuál es la lectura que hace el mercado de este comunicado. Vamos a ver sobre todo lo que tiene que ver con la inflación. Dice el Banco de México, las expectativas de mediano y largo plazo para la inflación se mantienen alrededor de 3.5%, lo que toca a las expectativas de inflación subyacente se han mantenido estables para los cierres de 2018 y 2019. Dice, considerando el comportamiento reciente de la inflación, la evolución de sus determinantes, la postura de política monetaria actual y el horizonte en el que esta opera, se prevé que la inflación general continúe disminuyendo, aproximándose a lo largo del año hacia el objetivo de 3% y alcanzándolo en el primer trimestre de 2019. Es un punto importante, ya es oficial, el Banco de México dice que el objetivo de inflación de 3% se alcanzaría en el primer trimestre de 2019. No lo había dicho tan puntualmente como lo hace ahora, fluctuando alrededor del objetivo durante dicho año. Dice, el retraso en esta trayectoria, está hablando de un retraso, está asociado principalmente a los efectos aritméticos que tendrán los incrementos de los precios de algunos energéticos y frutas y verduras que afectaron en los últimos meses la medición de inflación no subyacente. Por lo que se refiere a la trayectoria esperada de la inflación subyacente, se prevé que continúe descendiendo gradualmente y alcance niveles cercanos a 3% en el primer trimestre de 2019 y se mantenga alrededor de dicho nivel en el resto del año. Las previsiones anteriores consideran un comportamiento ordenado del tipo de cambio, la ausencia de presiones provenientes del mercado laboral y una reducción importante de la inflación no subyacente a lo largo de 2018 en la medida que no se repitan el tipo de choques que la afectaron el año anterior. Y obviamente también reconoce que el escenario anterior está sujeto a riesgos al alza, que se registre una depreciación de la moneda nacional en respuesta a otros factores, a una evolución desfavorable del proceso de negociación del Telecán, a una reacción adversa de los mercados a las acciones de política monetaria en Estados Unidos, a condiciones más restrictivas en los mercados financieros internacionales, a una volatilidad asociada al proceso electoral de 2018. Estamos viendo también la reacción del tipo de cambio, siguen moviéndose las cotizaciones del peso frente al dólar, pero en niveles cercanos a 18,85. La verdad es que no hay una reacción abrupta del tipo de cambio en este momento y podríamos decir, el Banco de México ha subido la tasa de interés en 25 puntos base, a 7.50%. Fue una decisión unánime de la Junta de Gobierno. Recordar que la Junta de Gobierno en esta ocasión ya está completa, con la incorporación de Irene Espinosa como subgobernadora, de hecho la primera mujer en la Junta. Y algo también importante que acabamos de revisar en el comunicado de política monetaria es que el Banco de México ya reconoce un retraso en la trayectoria de la inflación hacia la meta puntual de 3% que dice el Banco de México se alcanzará en el primer trimestre de 2019. Son dos informaciones importantes que hay en este comunicado de política monetaria y lo que estamos viendo es que la reacción del tipo de cambio sigue en un rango de estabilidad, no hay mucho movimiento en el tipo de cambio y veremos también más adelante cuál es la lectura que haga el mercado del comunicado de política monetaria de Banco de México. Decisión unánime de la Junta, sube la tasa de interés a 7.5% y reconoce que hay un retraso en la trayectoria de la inflación hacia la convergencia de la meta puntual de 3% que se alcanzaría en el primer trimestre de 2019. Son los dos puntos relevantes que se pueden leer en el comunicado del Banco de México que tenemos ahí en pantalla. Como vemos, la decisión ha sido unánime. Es todo por el momento, pero le invito a que me acompañe a las 3 de la tarde con toda esta información sobre la decisión de política monetaria del Banco de México y muchas notas más aquí en el Financiero Bloomberg. Gracias.
Percentage of GDP, we're back to the same debt to GDP ratios that we were at in the middle of World War II. That's not normal.
How do you make money in this transition to a new normal?
Well, you've got to stick to your plan. That's the problem that most investors have. They have long-term financial goals, and yet they have put in place short-term investment strategies. Owning equities with with the growth rates we're seeing, it's been a great earnings season. This is all really good. You've got to be able to get back into the market. Don't try to time it. When you time it, you got to be right twice, when to get out and when to get back in.
So when they are going back in, what are they looking at? What are the areas that are worth buying at this point?
From our perspective, in the U.S. market, which we're more favorable towards than international markets, but in the U.S. markets, you got to be looking at the financials, industrials, consumer discretionary.
The cyclicals.
Yeah.
And the ones that are being punished today.
Yes. Healthcare and REITs, but there are opportunities there. Those are the places actually where you can find, if you're concerned about valuations being stretched, valuations look a little bit more attractive. And the other thing is most U.S. investors, because of the challenges of the past, don't have enough exposure outside the United States, and they're underweight outside the United States.
One of the anomalies that we've seen this week is the unwind of some of these short volatility trades. To what extent are your clients saying to you, what else is out there? We weren't that cognizant of the risks associated with these products. How big is the risk that we continue to see these quite dramatic spikes in volatility, actually, that we simply weren't expecting?
Yes, people are certainly, what caused this big change? And so people point to the short volatility. Also, people are looking at closely related to the risk parity issues. And there's always something. But I think this overall trend is that we got to recognize that while we're still waiting on a correction in equities, we've had a correction in 10-year Treasury notes. Those are off 10, 11, 12%. So we've had more than a double of 10-year Treasury rates. That has to have implications for the rest of the capital markets.
So perhaps everything else is just catching up to the
I think there's some catching up that's going on,
All right, Eric Davidson, thank you so much, Chief Investment Officer at Wells Fargo Private Bank. Let's get you checked out on Bloomberg First Word News headlines with our Mark Crumpton. Mark.
Scarlett, thank you. While the Senate is expected to quickly pass a 2-year spending bill that would avert a government shutdown tonight, its chances of making it past the House are less clear after Democratic leader Nancy Pelosi yesterday objected to the bill's lack of immigration language during an 8-hour speech. House Speaker Paul Ryan today promised the issue would be addressed once the government is funded.
I know that there is a real commitment to solving the DACA challenge in both political parties. That's a commitment that I share. To anyone who doubts my intention to solve this problem and bring up a DACA and immigration reform bill, do not. We will bring a solution to the floor, one that the president will sign.
Speaker Ryan would not give specifics on any terms he thinks might be agreed to in any future immigration bill. Russia's election officials have registered 8 candidates for next month's presidential election, including the incumbent Vladimir Putin. With his approval ratings topping 80% and rivals trailing far behind, President Putin is set to easily win a 4th term. A Putin victory in March would put him on track to become Russia's longest-serving leader since Joseph Stalin. Syrian state-run media said today that a rare U.S. strike on a pro-government troop in eastern Syria is part of a new effort, quote, to support terrorism. A U.S. military official said the assault, which killed about 100 fighters, was in self-defense, citing an attack on allied forces elsewhere. Meantime, the Syrian government continues its own airstrikes on opposition-held territory east of Damascus. Eagles fans are releasing nearly 60 years of frustration today. The city is honoring the Super Bowl champs. The players have been riding through the streets of downtown Philadelphia atop trucks and double-decker buses. There you see the team's longtime play-by-play man, Merrill Reese. He's hosting a celebration on the steps of the Philadelphia Museum of Art, where the famous Rocky statue stands. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Mark Crumpton. This is Bloomberg. Scarlett.
All right, thank you so much, Mark. Coming up, Monday's implosion of the XIV is raising a lot of questions about other exchange-traded products that use derivatives. We're going to take a closer look at the risks of something else being out there. In the meantime, this is XIV over the past 5 days, down 96%. This is Bloomberg.
como el de 85 ocurriera en esta región, que es la brecha sísmica, dado que la distancia de la Ciudad de México es mucho menor. Hay cálculos que demuestran que el movimiento inducido en la Ciudad de México por esa ruptura hipotética aquí, similar a la del 85, sería de 2 a 3 veces más intensa en la Ciudad de México que el del 85.
This is Bloomberg Markets. I'm Julia Chastely.
And I'm Scarlett Fu. This week's dramatic plunge of the $1.9 billion exchange-traded note XIV is raising a troubling question. What other ETF problem children could be lurking out there waiting to implode? Joining us now is Rachel Evans, who covers ETFs for Bloomberg News. And Rachel, there's a lot of questions out there about whether XIV is just the tip of the iceberg. But when you think about these short volatility exchange-traded products, there's another one out there that hasn't been taken apart, and that's SXVY, which is an exchange-traded fund. Talk us through why SXVY is still trading right now when it does the same thing as XIV.
So SVXY is basically it's an ETF. It's an exchange-traded fund. So what that means is that when you get to a liquidation, it's really kind of up to the issuer, or rather the board of an ETF, as to whether they choose to close a fund down. It doesn't necessarily have to close. Whereas with an ETN, within the terms and conditions of the note, it explains that the issuer, Credit Suisse, is able to accelerate that note and terminate it if there's a sudden drop in the price.
Right, and the ETN carries credit risk in a way that the ETF doesn't.
What are we seeing in terms of flows in and out of the existing funds now that still exist versus, of course, XIV, as you were just saying, now is being, at some point, being liquidated?
So we've actually seen inflows into SVXY since we've had this troubles. We're also seeing these products among the most traded of the day. Now, the latter worries me less than the former because, I mean, when you look at kind of these products, they're really designed to be trading vehicles. So on a day like today, where markets are moving around a lot, using a volatility product, whether you're going long or going short, makes a lot of sense.
You mean a day trade?
Exactly, day trading. When it looks at the volume of the turnover of shares that are happening today, they're among the highest traded. But when you look at actually inflows going into these funds, that's not necessarily a problem. But if those people intend to hold the fund for a while, that could be an issue. The roll cost could start hitting on their returns. They could also find themselves subject to some of the fluctuations that we've seen as the short vol trade plays out.
All right, so we're certainly looking at SVXY and seeing how that plays out. What about some of the other ETFs or ETPs, in general, exchange-traded products, that are based on derivatives that could be another problem area for investors?
So I think investors are now sort of having to take a hard look at their portfolios and think about what they own, which they probably should have done in the first place, but it's better late than never. And I think when you look at sort of derivative-based or derivative referencing products, I mean, they're definitely an area where people need to pay particular attention and proceed with caution.
How big is this market as a proportion of the overall size of the market here?
So when you look at the number of products, it's relatively significant. You have about 400 products that reference derivatives or swaps. That's about 20% of the market. But when you look at the actual assets in those, it's more like 70 billion, and it's a 3.5 trillion market. So they're relatively small asset-wise. And that's good, because these products are not designed to be held. They're designed to be traded.
But the other thing is the ETFs or the ETNs are kind of the tip of the iceberg, because there could be trading strategies that mimic what happens in the ETF or ETN.
Now, we were talking about this on What You Missed yesterday. Somebody offered a portfolio of corporate bonds, but it was souped up with volatility products, and the returns...
With the XIV.
The back returns looked absolutely fantastic. Talk to me about the liquidity in this, because it's part of the problem here. Just actually, if you want to try and get out of this product, and there's a lot of people trying to do that, then actually when you need it, liquidity simply isn't there.
So for the ETFs, I'd say that a lot of the market makers will tell you that there is a market for them. If you want to trade your shares, you will be able to get in and get out. The issue really comes when you look inside these products. So if these products rely on being able to buy and sell futures at a particular point, like the end of the day, then that could be a problem if there's a liquidity crunch in the underlying market.
I remember in the financial crisis, there was a lot of focus on the leveraged ETFs, the ones that bet 2 times on financial stocks, or the inverse of 2 times, or 3 times even of financial stocks. Those were always leading the gains or the losses. To what extent is that another problem area? Because that certainly is meant to be a trading vehicle as well, and not a buy and hold proposition.
Well, these funds are still around, that's for sure. You can absolutely go 3 times levered or 3 times inverse on numerous different markets. When you look at those, they are often among the biggest gainers and the biggest losers. And that's why we find that although they're trading tools, retail is really attracted to them. If you tell somebody they can make 200% back in a day, well, over the course of a year, they're going to be pretty enthused by that, and they will want to get a piece of that action. And what's really interesting is that when you actually look at attempts in the past to limit leverage or limit the use of derivatives, it's often retail investors that really push back against that. And
they don't want that.
They say, don't take it away from us. We want the opportunity to play with the big boys.
Yeah, they want the returns like anybody else. I mean, BlackRock, of course, the world's largest ETF issuer. These guys, I can hear it, read it so many times when they're saying, look, we need to see greater regulation of the leverage products in particular, because they're not... they don't perform like an ETF.
That's not their business either.
Yes.
Well, that's a good point, right? I mean, everybody talks their book a little bit in these situations.
So where are the controls? Thank you.
So I think BlackRock, I mean, obviously they don't have these levered products. They don't have a derivative-based products. And as a result, I can see why, as the largest issuer, they don't want anything that comes out and taints this market for them. Some of the more leveraged derivatives-focused products would say, look, we're not in the market of trying to blow ourselves up. We have created trading tools that are designed for professionals, and when used correctly, can be additive.
Well, that's a key, right? When used correctly.
Exactly.
How do they make sure that these products don't end up in the wrong people's hands, that don't end up in the hands of the guy who was a manager at Target, quit his job to bet on XIV?
But the point that they make is valid, and that is, where are the regulators here?
Right. So, I mean, that's the real key question, I think, that's kind of coming out of all of this. When you look at the Securities and Exchange Commission, their approach to approving all forms of exchange-traded products, or ETFs anyway, has been very much disclosure-based. They look at disclosing the risks and in trying to encourage investors to read those risks.
In the prospectus.
Absolutely.
Which they read after they've bought it.
Right. And then on the other side, you've got FINRA, which is supposed to go in and actually take action against brokerages that mis-sell these products, that put them in an unsuitable investor's account.
But that's after the fact.
That's after the fact, exactly.
So what about a possibility of a rating system? I know this has come up in your reporting where, and Eric Balchunas talks about this all the time, movies are rated, bonds are rated, rap records are rated. Why not ETFs?
It's a good question, and I think it's something that people will start to consider more seriously going forward. We're now at the point where ETFs are or ETPs in particular, are a very large proportion of the equity market that gets traded on any given day.
Yep.
They're also increasingly taking over from mutual funds as the way that people invest their money. When you have a product that is designed both for long-term investing and short-term trading, you need to have some kind of way for people to differentiate between which product really works for which purpose.
Right. Rachel, I'm going to put you on the spot now. Are we going to see blow-ups like we saw earlier on in this week with products out there potentially at some point going forward, if we see the same kind of sort of choppiness, volatility spike that we've seen over the last several sessions?
I'd be shocked if we didn't see something going forward. I mean, quite what time frame we sit under?
Exactly.
I mean, that's a big question. But I mean, there are certainly products out there that in the wrong hands can be very painful. If you know what you're getting into, then you know that something like XIV can happen to you. It's clearly in the documents that it could go to zero.
Yeah.
But in terms of that hitting investors that don't realise it, I think it's only a matter of time.
Yeah, Rachel, some really great insights, smart comments. Thank you. Rachel Evans, who covers ETFs for Bloomberg News. Right, let's just give you another check on what we're seeing as far as the markets are concerned. I'm just showing you the US markets here. As you can see, right now we're down by some 1.8% for the Dow. I'm just looking at it here. We are off the lows, and we should make that point, but still under some selling pressure here. Similar story as far as the VIX is concerned. We're higher by just over 7%. We were significantly higher early on in the session, from the start of the session to at the peak here, up some 26%.
Yeah, VIX was above 34 at one point.
It was. So we have had some huge spike early on in the session. We've come back significantly as the market has bounced off the lows. Want to quickly point out Europe as well. As we started to see the selling pressure in the United States, Europe also began to sell off and finished on the lows of the session, 2.6% down for the German markets too. God, remember, this is a global issue that we're seeing, the pressure across equity markets. Plenty more to come from us. This is Bloomberg.
Los toros como negocio, espectáculo y cultura. Tiempo de Toros. Con Rafael Cue, viernes, 9 de la noche. Retransmisión, sábado, 9 de la mañana. Porque reconoces lo importante, el Financiero Bloomberg.
It's time for the Bloomberg Business Flash. Look at some of the biggest business stories in the news right now. BlackRock wants to raise more than $10 billion to buy stakes in companies. According to a person familiar with the matter, the world's biggest money manager would make investments on themes like the growing middle class. Viacom shares are surging despite reporting lower revenue for the first 3 months of the fiscal year. The company predicted today that advertising sales will return to growth within the year. And that is your Business Flash update.
How very private equity-like. Coming up, down to the wire as lawmakers hammer out a deal to avoid yet another government shutdown. We'll speak with Alabama Congressman and conservative House Freedom Caucus member Mo Brooks. From New York, this is Bloomberg.
Economía, cierre de bolsa, negocios, finanzas. Víctor Piz presenta lo más relevante de las noticias al sonar la campana. Con Víctor Piz, lunes a viernes, 3 de la tarde. Porque reconoces lo importante, el Financiero Bloomberg. La industria de intercambios comerciales se convierte en un negocio de equidad en Estados Unidos y el mundo. Bloomberg ETF IQ, un nuevo programa enfocado al análisis de este nuevo concepto comercial. Todos los miércoles, 11:30 de la mañana. Porque reconoces lo importante, el Financiero Bloomberg.
From Bloomberg World Headquarters in Midtown Manhattan, this is Bloomberg Markets. I'm Scarlett Fu. We need to check in with Julie Hyman once again to see how stocks are faring. I believe this is the fourth decline in 5 days.
Yes, indeed. And now we are seeing this 9-session decline, really, with a couple of minor exceptions for the S&P 500. Stocks, as we talked about before, they're up off the lows this session, but sort of heading back in the downward direction here, with the Dow and the NASDAQ each down closer to 2%. The NASDAQ down 1 3/4% here as we approach the end of the session and what has been a turbulent time, almost getting close to the last hour of trading, or now in the last 90 minutes of trading. I should mention as well, it's interesting today because when we started to see selling accelerate, we saw volume, trading volume, pick up on the S&P 500. Let's look at the current landscape of what is falling the most. We've got financials in the bottom spot today, down 2.5%. And I should mention financials were falling even when we were seeing bond yields rising, which is a bit unusual. Consumer discretionary, tech, and telecom are now all down at least 2%. Utilities, the lone group, in the green at the moment. To dig into the financials a little bit more, some of the big cap banks have been declining today. We've got JP Morgan and Bank of America each down 2.5%. And really, the selling is concentrated even more in the insurance companies. Prudential out with its earnings today, and in particular, its earnings beat estimates, but it said expenses rose in the last quarter. Allstate also reported its numbers, its operating margin coming in below what analysts had anticipated, so those shares taking a bigger hit. And now let's look at the bond market, because we did have that 30-year auction earlier today, which drew weaker demand. It wasn't quite as weak as the 10-year auction yesterday, but was indeed weaker. So we've got selling here now happening for the Treasury market. It's really been bouncing around today as well. It's been unusual to see that. The bouncing around has mostly been limited to what's happened in the stock market. So the 2-year yield is unchanged at this point. 10-year yield going back up to 2.85%, and the 30-year yield rising to 3.14% in the wake of that weaker auction. Also, as we look at other assets, let's take a look at oil prices, because oil selling has now extended into its 5th straight session. The decline during that period is 7%, as we've seen this risk-off tenor spread to oil as well. The drop you saw yesterday was in the wake of inventories, and so then that selling has just continued on through. Julia?
Thanks so much, Julie. We'll be back with you later in the show. Right, let's go to check now on the headlines on the Bloomberg First Word News at this hour with Mark Crumpton. Mark.
Julia, President Trump says faith is central to American life and liberty. Mr. Trump addressed the National Prayer Breakfast this morning, a high-profile annual event in Washington that brings together faith leaders, politicians, and dignitaries.
Americans are able to live by their convictions, to speak openly of their faith, and to teach their children what is right. Our families thrive, our communities flourish, and our nation can achieve anything at all.
The president also spoke about seeing what he called the power of God's love in Americans, particularly during the response to recent hurricanes and mass shootings. In Seoul, Vice President Pence met with South Korean President Moon Jae-in. At a joint press conference, the vice president reiterated the U.S.'s commitment to help South Korea achieve stability in the region.
That the United States of America will continue to stand shoulder to shoulder in our effort to bring maximum pressure to bear on North Korea until that time comes when they finally and permanently and irreversibly abandon their nuclear and ballistic missile ambitions.
Earlier, the vice president said, quote, "We'll see," in regards to whether the U.S. might meet with North Korean officials during the upcoming Winter Olympics. He'll attend the opening ceremony tomorrow in Pyeongchang. President Moon said he hopes the games lead to more dialogue on the denuclearization of the Korean peninsula. The wife of a conductor killed in a South Carolina train crash says 2 rail companies are to blame for her husband's death. Michael Sella's widow has filed a lawsuit accusing Amtrak and CSX of negligence. Sella and an Amtrak engineer were killed Sunday when their passenger train collided with a parked CSX freight train. More than 100 passengers were injured. Sella's widow says CSX was negligent in locking a manual switch that forced the passenger train onto the sidetrack. Construction workers on the Israeli side of the country's border with Lebanon were seen today setting up cement wall blocks near a border village. Lebanon has been protesting the construction, saying the wall would encroach on its territory. Lebanon says it is in contact with the United Nations and some unnamed countries to help ease the tension with Israel over the project. Global News 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Mark Crumpton. This is Bloomberg. Julia.
Thank you very much, Mark. Now, as lawmakers in the House and Senate try to reach an agreement on the bipartisan budget proposal before a critical midnight deadline, the Conservative House Freedom Caucus has drawn a clear line in the sand, tweeting last night, quote, HFC, the House Freedom Caucus, opposes the caps deal. We support funding our troops, but growing the size of government by 13% is not what the voters sent us here to do. We're joined now by Congressman Mo Brooks of Alabama. He's also a member of the House Freedom Caucus. Congressman, great to have you with us. Thank you so much for joining us. Is the ultimate message here, then, that a GOP-led shutdown at this point is preferable to voting for this budget proposal?
No, I don't think so. I think there are other options out there where we can do the right thing. We can minimize our risk of, as a nation, going into insolvency and bankruptcy and still keep the government operational. I'll give you an example. On Tuesday, the House voted to send a funding bill to the United States Senate that significantly increased defense spending, over $60 billion, and level funded the rest. And normally, if they don't like that, the compromise is, well, we don't want $60 billion for national security. We want 40 or 30 or 20. And I think that possibility is still out there with the bill that we've already sent over to the United States Senate. If this effort no easy way to say it, if this effort to bankrupt America does not pass in the United States Senate or the United States House today.
Well, yes, that might be the case, but the president has already backed the Senate's version of the budget deal, saying that it gives the Department of Defense the funds that it needs for the military. He urged lawmakers to support our troops. So did the bill that we passed on Tuesday. Right, but he backed the Senate bill, and he backed it publicly. He tweeted about it. Senator Corker said that the budget deal would deliver more military funding that the president requested in his 2018 budget proposal. Would you be in favor of perhaps reducing the allocation to defense spending?
I am in favor of being financially responsible in order to minimize the adverse effect that a bankruptcy and insolvency will have on the United States of America. One significant adverse effect, if our creditors decide they just don't want to loan us any more money, is we don't have the money to pay for national defense, and you have to worry about a dissolution of our military extreme example or dramatic cuts as the most probable example of what would ensue. So you can't just look short term and be myopic and talk about today, tomorrow, next month, or a year from now. You also have to look 5 and 10 years down the road and try to determine where you want to be as a nation. And we do not want to have a consistent string of $1 trillion a year deficits that add on to our $20 trillion accumulated debt that results in, at some point, our creditors saying, no mas, no more. We're not going to give you any more money, at which point you've got a horrific situation that the United States is going to have to deal with. We have to avoid that at all costs.
I know that the Freedom Caucus is very concerned about government spending, but what specific spending would you propose be cut here? Let's get to the basics where we can really hear from you on what specific spending proposals should be included, cutting proposals, excuse me, and whether you put that into a legislative proposal.
We spend over $50 billion a year, directly and indirectly, on foreign aid. That's a good place to start. There are military aspects of what we do around the globe that I think we need to shift to some of the other countries who have a greater interest in those regions than we do. By way of example, the South China Sea. China is expanding. They're building military bases. They're building islands on which to build military bases. Why can't South Korea, Japan, the Philippines, Taiwan, and other nations in that region of the world pick up the pace some and relieve us of so much of the financial and military responsibility. Same thing with the Persian Gulf. We used to be heavily dependent on that Persian Gulf oil. We aren't anymore. Why shouldn't we expect South Korea and China and India and Western Europe and Japan and other nations to start picking up the tab to keep those shipping lanes open in a relatively volatile part of the world? Why do we always have to pick the tab up? Or in NATO, our NATO allies in Europe, they have a bigger economy, they have a greater population than their alleged foe, Russia. Why can't they defend themselves more without the United States of America have to picking up so much of the tab? So there are places that we can cut that you asked for them. I gave you some. I can give you more, but we have limited time.
No, I know. And Congressman, you do make some very valid points here as well. But is the bottom line here actually that the House Freedom Caucus can take a bold stand here ultimately because Speaker Paul Ryan has the votes because he can take them from the Democrats?
Well, that's something that has happened on a regular basis. Those of us who try to be financially responsible, we get outmaneuvered when the House leadership decides to cut a deal with the big spenders on the Democratic side of the equation. And quite frankly, those of us who are financially responsible, not just in Congress, but in the United States of America, we collectively get hung out to dry. But the price is going to be paid when our creditors decide that they no longer feel comfortable loaning us the money. Right now, for example, this year with $1 trillion expected deficit, if this bill passes, that's about 20 to 25% of our total spending. I ask you, where is that money going to come from if our creditors decide that they just don't feel comfortable loaning us more? Not asking us to pay back what they've already loaned, but loaning us more. And the stock market long term, if I have time to go into this, there's a significant adverse effect of the United States government dipping into the credit markets, trying to take $1 trillion, 1.2, 1.5 trillion, as the case may be, going further into the future, out of the credit markets. Interest rates are going to go up. That's going to dramatically hurt the stock market in two different ways by driving up the cost of doing business. A lot of companies borrow money. That's an increased cost to do business on the one hand. And on the other hand, as interest rates go up, people who have money, you're going to see them shifting out of the stock market to some of their interest-bearing investments. Right. And that's going to have an adverse effect on the stock market, too. So there are a lot of cascading effects that are bad that we need to avoid.
The tax overhaul already added to. I guess we should make that point. But I just want to talk about your concerns.
Well, I can go into that in more detail, too, as to why we did it, if you wish.
No, I understand.
It's our last chance.
I understand, Congressman, but I want to ask you. I want to ask you about what you were saying about the concerns about the increase in military spending, and just get your views on the president's desire to have a military parade. This is just a quote that we got from Senator Kennedy saying, look, we're not North Korea here, we're not Russia, we're not China, and we don't want to be. And for that reason, I would be against flaunting our strength. We don't need to show everybody. We don't need everybody to know we have it. Are you also critical of this decision by the president to want to hold a parade at this point? Do you share others' outrage?
The president is the commander-in-chief. If he wants to have a parade, he's going to get to have a parade. Personally, I would rather those millions of dollars be spent on better training for our military personnel, better weapons for our military personnel, so that when they are in conflict, they have a better chance of not only triumphing, but live after the battle's over with.
I hear you. Congressman, thank you so much for joining us. Congressman Mo Brooks of Alabama.
All right, let's get you another check here on the markets. Take a look at the indexes. I have it up on my Bloomberg. We're looking at the S&P, Dow, and NASDAQ resuming their decline as we head towards the final hour of trade here. They had recovered shortly before 1 p.m. That was their low just before 1 p.m., but we're back towards the lows of the session here as we head into the final hour. We're also looking at the VIX moving higher as a result. The fear gauge, which basically tracks the cost to protect against declines in the S&P 500. And you might not be surprised to see yields moving higher as investors are selling treasuries and other yields rising as investors sell treasuries. This is Bloomberg.
La economía mundial se enfrenta a cambios nunca antes vistos. El presidente de Bank of America conversa con David Weston sobre sus perspectivas de negocios. A Conversation with Brian Moynihan. Sábado, 9:30 de la noche. Porque reconoces lo importante, el Financiero Bloomberg.
This is Bloomberg Markets. I'm Scarlett Foe.
And I'm Julia Chatterley. And it's now time for a stock of the hour. I'll give you a quick look at the US major averages. The Dow is moving, down 2% or more, actually, at this stage. Let's bring in Abigail Doolittle, who is looking at that, and the sector spider report.
Thanks so much, Julia. Well, we are looking truly at a sell-off for the major averages stocks here on this Thursday. The Dow, S&P 500, and the NASDAQ all sharply lower, down about 2% or more. The Dow down about 580 points, so not quite at session lows, but nonetheless a continuation of the pullback that started last week, really intensified on Monday, and then all of the volatility that we have seen this week continuing today. The major averages on pace for the worst day since Monday. The story of this pullback, rising yields. We have the 10-year yield higher by about 1 basis point. So Haven bonds are selling off with stocks, the repricing of risk. Investors not liking the fact that rates are rising, in fact, to the degree that that's not even influencing the sector IMAP or the IMAP and the S&P 500, the sector composition here. When we hop into the Bloomberg, just moments ago, all the sectors had been lower, but utilities trading higher despite the fact that yields are also higher. That typically doesn't happen. And when yields are higher, typically that helps the financials. But take a look at the financials. That is actually the worst sector on the day, down 2.4%. So the selling that we're seeing that so far has been relatively orderly, even though it's been big. We have not had the fear of the capitulation. We're also having some of the relationships that we would normally see out of whack. So the sector spider ETF that we're taking a look at today, not surprisingly, the XLF, the worst sector for the S&P 500, down 2.5%. Really a continuation again of the selling action that we have seen indiscriminately across the board. Lots of the big financial names. In fact, let's take a look at those, including Bank of America, JP Morgan, Citigroup, Wells Fargo. Lots of selling pressure here. And one point of pain, because again, we have rates rising. Typically, that would help the banks. We do have what appears to be a tougher Fed, tougher stress test, plus Wells Fargo receiving that cease and desist. Investors a little bit spooked here. It's creating a very unusual relationship. If we hop into the Bloomberg and take a look at #BTV 5956, this is a six-month chart of, in white, the XLF, in blue, the rising yields, the rising 10-year yield. And we see last year in lockstep, rising rates tend to help the banks in their lending activities. But just recently on this pullback, we have rates moving higher, and we have the XLF, or the financial sector, moving lower. That's a point of pain, because last year when we did have rates moving higher, that actually was offset by the fact that the financial sector was a leadership sector. That's not the case right now. So if this continues, this repricing of risk, investors adjusting to the possibility of what is the new cost of money, we could continue to see the pressure on the overall major averages, and certainly the financials. Not technically very strong there, suggesting that the financial sector really might just break down in the not-so-distant future, Scarlett.
Yeah, the repricing can take a while to sort through. Abigail, thank you so much. All right, we have some breaking news. Blackstone and Cerberus, the private equity firms, are said to be among the bidders for Spain's Cirsa Gaming Corporation. That is a Spanish casino and bingo hall operator. We also have learned that Advent International and Apollo Global Management are also considering offers for this business as well. This is according to people who are familiar with the matter. Cirsa has also attracted interest from other gaming companies as well. So Cirsa certainly in demand here. Blackstone, Cerberus among those looking into it.
Right now, coming up, we'll hear from our exclusive interview today with the New York Fed President Bill Dudley, why he says the market volatility so far is small potatoes. This is Bloomberg.
quién ganó y quién perdió en la jornada de negocios. Susana Sáenz tiene los nombres, datos y hechos tal como son. Ganadores y perdedores con Susana Sáenz. Lunes a viernes, 4 de la tarde. Porque reconoces lo importante, el Financiero Bloomberg.
It's time for a Bloomberg exclusive to give you some perspective. The New York Fed President William Dudley spoke to Bloomberg's Kathleen Hayes. They discussed the current market volatility and his views.
Well, I don't think we know now, but clearly the market is adjusting to the fact that the global economy is growing quite quickly. And as a consequence of that, monetary authorities around the world are either starting to remove accommodation or are thinking about starting to remove accommodation. And that's a little different from the environment we were in the prior, 7 or 8 years. So bond yields have moved up, and as bond yields have moved up, that's put a little bit more pressure on the equity market, and I think the equity market has adjusted in response. Now, in terms of what it means from the central banker's perspective, this is all about, magnitude and duration. The little decline that we've had in the equity market today has virtually no implications for the economic outlook because it precedes a very, very large rise in the equity market over the last few years. So if it stops here, the implications for the economic outlook are very marginal, and so probably not going to change our thinking about the economic outlook. If it were to go on much further, and be much more persistent, then it could start to affect household and business spending behavior, and then that could actually start to influence the economic outlook. But so far, I'd say this is small potatoes.
But I also want to put on the table that as I was thinking about this and talking to you today, I was thinking about 2015. When we came into the year, the Fed's going to hike rates in March, and then there was, Brexit, and then there was a big sell-off in the Chinese stock market. It hit U.S. stocks. Fed passes in the summer, passed on a rate hike again in September, only one rate hike that year. So clearly there's a point where markets and market volatility can have a very definite impact on the Fed's path.
I think it depends a little bit about why are the markets doing what they're doing. In the first quarter of 2016, it wasn't just about the markets. Commodity prices were falling very sharply. This is putting a lot of pressure on emerging market economies that were dependent on commodity exports. China was going through a pretty difficult adjustment. So it wasn't a market event per se. It was really things that were actually happening in the global economy. I think this is a little different. The global economy is doing fine.
So I want to look at the sort of the anatomy of where we've gotten over the last week, because you were talking about the economy looking better and markets starting to factor that in and price that in. Certainly there was a jobs report on Friday, but on Wednesday, the Fed's policy statement added the word further twice, talking about rate hikes. A lot of people said, oh, it's a signal they're going to move more aggressively. I said, everyone's overdoing that, but I have to ask you, what was that further intended to signal?
Well, I can't comment for the committee because I'm sure the word means different things to different people. I think from my own perspective, just speaking it from my own perspective, I would say maybe a little bit more confidence in the strength of the economy on the back of more momentum through the end of the year and a large tax cut package. I mean, the two things that have really happened as we went from early in 2017 to now is the economy has picked up momentum. And we've gotten a big fiscal package, and so and the unemployment rates continue to decline. The labor market stayed very strong, and so, I think, speaking for myself, I have more confidence in the durability of the expansion, and more confidence that the Federal Reserve is going to have to continue to remove monetary policy accommodation.
So on Friday, in the jobs report, the payrolls were a little bit stronger than expected. That was not such a market mover. That wasn't the headline that grabbed people. It was the average hourly earnings up 2.9% year over year, up from 2.6%. And they've been stuck around 2.5, 2.6, 2.4 for a while. Bam. Oh, wages finally starting to accelerate. More inflation. Not just 3 rate hikes, 4 rate hikes in 2018 now possible. What do you see?
I think It's going to really depend on how the economy evolves. I think it's really premature to make predictions about whether it's going to be 1, 2, 3, or 4. Clearly, with the December summary of economic projections, the median projection was 3 rate hikes in 2018. That still seems like a very reasonable projection. If the economy looks stronger as we go through the year, could that 3 turn out to be more? Perhaps. On the other side, though, if the economy starts to look softer or inflation doesn't materialize like people expect it to materialize, then the Fed could go a bit slower. So I think that the jury's out. When we write down these summary of economic projections, they're not a commitment to what we're going to do. They're a forecast at that time. And so if the economic outlook changes, then we're going to change what we do. And a good example of that is the one that you brought up earlier, December 2015. As the global economy looked a little bit shakier in the first half of 2016, we slowed down.
New York Fed President Bill Dudley speaking today with our Kathleen Hayes. And coming up, we've got another exclusive. We'll be hearing from our conversation with Robert Kaplan, the Dallas Fed president, why he says the market volatility may be a healthy thing.
That healthy word again?
Yeah, it comes up quite a bit. This is Bloomberg.
¿Cómo acabaron los mercados financieros y cómo arrancó el mercado político? Un noticiero que da seguimiento a la información que marca la agenda en México. Entre Mercados, con Lucero Álvarez. Lunes a viernes, 5 de la tarde. Porque reconoces lo importante, el Financiero Bloomberg.
York, 12 p.m. in San Francisco, and 8 p.m. in London. I'm Julia Chatterley.
And I'm Scarlett Fu. Welcome to Bloomberg Markets.
We are live in Bloomberg World Headquarters in New York. Over the next hour, here's the top story we're covering on the Bloomberg and around the world. U.S. stocks resume their slide as volatility grips the global markets. The S&P 500 tumbling as much as 2.4%, erasing its gains for the year, while the VIX Volatility Index was more than double its level a week ago. Let's get some more perspective now on the markets with Bloomberg's Julie Hyman, and I make that the lows of the session.
Yes, the lows of the session are very, very close to it as we head into the close. As we've talked about, Julia, the last hour of trading tends to be turbulent. We tend to see, even on a normal session, more volume into the close of trading. And if there is any kind of switch there, that is typically when we see it happen. So indeed, we are looking like we're making the lows of the session here. Julia just mentioned the VIX is about double where it was just a week ago. Recall as well that at the end of 2017, we were at record lows for the VIX, below a reading of 10. And now, of course, we have that 32 handle on the VIX as volatility continues and persists. And we have had some investors, even those over the past few days, who have said that you should step in and perhaps buy here. Even those folks have said you may brace for a little more turbulence in the days ahead. And that is indeed what has materialized. If you take a look at the major averages, it's notable that last year, all of last year, the S&P 500 only fell 1% on 4 separate occasions. Now, thus far in 2018, it's already happened 4 times. And you see here the 4 times that it's happened for the S&P 500 with the 1% marker right around here. In fact, the Dow and the S&P have both fallen 1% on 4 separate occasions here. And you see the major averages and the drops that we have seen over the past week or so, which now for the S&P 500 amount to more than 8%. Now, also, some other ways that we are sort of trying to dig into the internals of the market is to look at how many members of the S&P are trading above the 200-day moving average. Just a way of looking at momentum of the members within the S&P 500. So on the top here, you have that 200-day moving average and the S&P itself getting closer to it. On the bottom here, you have the percentage of members trading above their own 200-day moving averages. We're at about 67% at this point, but consider that at the highs, there were more than 80% of S&P members trading at that level. Let's get to today's session and the movers that we are watching, or at least some of them, some examples of them, both on the up and the downside, because it's interesting to note that we still have some pretty standout winners. Twitter reporting its first real profit and a surge in revenue, those shares rising. Coty, the cosmetics company, also reporting a strong quarter, and so those shares are higher. But on the flip side, we've got Hanes brands, which reported weaker than estimated numbers, and a forecast that reflects weakness in its champion brands in particular. And Teva Pharmaceuticals' new CEO basically saying, don't expect a recovery this year, as there is still a lot of challenges in the generics business generally, and with Teva specifically. And then finally, outside of stocks, we got to look at the so-called haven trade today and what we're seeing in other assets, as we do see some selling in the Treasury market, interestingly. So not necessarily havens coming in that, people looking for a haven there, but we are seeing some buying of the Japanese yen. We are seeing some buying of gold as well. So it's not sort of a wholesale flight to safety, if you will, but we are seeing it in some quadrants. Scarlett?
All right, Julie Hyman, thank you so much. Let's get more on the markets as stocks decline for the 5th time in 6 days. Joining us by phone is Tom Lee, head of research at Fundstrat. And Tom, I know you've said and called this sell-off extremely healthy because it's months overdue and it's not in response to worsening fundamentals, and that it's a reaction or recalibration to the fact that central banks, including the Federal Reserve, is moving away from the excessive easing we've seen in the past. The higher interest rates is also healthy. At what point, though, could it get unhealthy?
Well, in some ways, since 1980, markets have generally favored lower rates, right? So we know that higher rates scare people, and it seemed like 2.7% was a break point this year because rates have been rising since August of last year. I'd say if we did something as simple as look at where do rates hit a level that scare markets, it seems like it's followed a trend line from 1980 to now, where the 2000, 2007, 87, and have bumped up against this line, and that's when markets get concerned. So that number would be like 375 today. But I think that we're really in a world where higher inflation is actually good for stocks now because it's going to help reset reflation expectations. It's going to help corporate profits. It's going to actually help the deficit because higher rates, along with a progressive tax system, means high inflation means government budget deficits actually will shrink. So I think this is more of a 1950 to 1975 period where 5 of the big rallies in that 25-year period all occurred when rates were rising. So as much as it feels like it's a bad thing now, I think we're going to look back and realize higher rates is actually good.
It should also be good for consumers too, shouldn't it, if we get paid a bit more as well, Tom? The problem is, as you say, we're going to look back on this and say it was a good thing. How long before we can look back and go it was a good thing? I mean, investors at the moment are concerned, nervous?
Yeah. I mean, this week's really, this week's created a bit of turmoil. Part of it is because of what's happened to some volatility products. And part of it's because the market's now just essentially repricing risk, and I think that's really healthy. I mean, it's, we don't really want to live in a low-vol world because PE would go to infinity. So I think we have to deal with people de-risking. There's actually systematic liquidations that are taking place now. But when I look at the VIX term structure, so not just spot VIX, but what the future VIX is saying, I think the worst of it's behind us. Like I don't think we're actually going to make new lows, even though it's been sloppy the last 2 days. So I would still consider this to be a dip you have to buy.
Explain that, Tom. What do you mean by the term structure is telling you that we've seen the worst of it now and it's past?
Yeah, so normally when you look at VIX, and VIX, remember, is not just a spot market. It's a series of futures contracts that expire, and you can even look many, many months out. Normally, it's positively sloping, meaning that historically you expect VIX to be higher in the future. Today, the spot and the 1-month contracts are way above the 4-month contract. In other words, the market's pricing in a very big volatility spike within the next 30 days. That's every time that's happened since 2004 when the first contract started. It occurs near market bottoms, but the magnitude of that inversion on Monday was the largest since November 2008. And November 2008, as you all recall, was the structural low of the S&P in that huge bear market.
So, Tom, let me ask you, because we were speaking about this with Rachel Evans earlier of Bloomberg News, who wrote about how the spotlight is now on these ETF problem children. We've seen the XIV kind of blow up, and we're worried, or we're thinking maybe that there are going to be other ETPs that are similarly designed that could similarly see a big plunge, an unexpected plunge, a rush for the exits. Do you share that concern that there might be other problems lurking beneath the surface here?
Well, one of the problems with financial markets is that many innovative products often come with surprising problems because you're never really getting rid of volatility. You're either pushing it out or you're raising amplitude. So I'm not surprised that in a low-vol world, especially because last year really seemed to anchor it, right? Inflation fell and VIX fell, and as you know, implicitly when VIX falls, a lot of other behaviors take hold. I'm sure that there is some other, grossly dangerous instruments out there, but I don't think it poses systematic risk. Just because, as you know, post-2008, I mean, financial entities just aren't as levered as they used to be, so it's not like a forest fire that has no firewall. The firewalls are going to, stop with the banks now and the brokers and the exchanges because leverage is much lower.
Yeah, interesting. Tom, I also want to just talk about this on a global basis as well, because we are seeing a repricing of rates in Europe. We had the Bank of England today, Governor Mark Carney, saying they may need to raise rates quicker than expected. They actually raised their growth forecast, which we could see as a positive here too. Just when you look globally as a result of this, do you see opportunities as a result of the repricing here that we've already seen?
Yeah, I mean, again, I think we're certainly shattering 10 years of, hey, I'm willing to own negative interest rate bonds. Remember, at the peak, 20 trillion of bonds had a negative interest rate. I mean, it's crazy.
Yeah.
But I think more importantly, we're probably reversing 30-plus years of expecting lower interest rates. This is a huge, huge shift. I think, towards value-style investing. To me, the biggest lesson in 2018, and the one that we're urging our clients to focus on, is you got to shift away from focus on growth and focus on sectors and industries that benefit from higher rates. And that's more value-style investing. Because it takes a whole lot of E to offset a PE contraction. So it's better to focus on things where the E goes up because of higher rates.
Okay, so if we go towards more value sectors, then does that mean they're going to be in the U.S. and we're looking at the likes of utilities, staples, or are we going abroad where there hasn't been as much froth or a little bit less froth in some of those asset prices?
Yeah, the answer is a bit of both. I mean, I think the commodity complex is a huge winner. And, you know, last year we said energy was making a generational low. And in a generation we'll find out. But I think that means you want to be overweight energy and materials. That's a lot of EM and a lot of commodity-producing countries. Financials are huge winners, especially U.S. banks. I do think capital spending benefits and industrials, because of their exposure to the commodity complex, is a winner. And then I think wage inflation means old tech, you know, automation, SaaS, those are really great businesses and ones that demand will grow. So, you know, our sector theme this year is ICRAP. It's an acronym for the value and commodity-sensitive groups.
Got it. Tom Lee, head of research at Fundstrat, thanks for joining us by phone today, calling this sell-off extremely healthy. Let's get you now to Bloomberg First Word News with our Mark Crumpton. Mark?
Scarlett, thank you. House Minority Leader Nancy Pelosi has sent a Dear Colleague letter in which she writes that she won't vote for the bipartisan spending deal because it doesn't come with a promise to address the plight of dreamers. Pelosi also writes that the spending deal does contain investments in Democratic priorities that will create jobs and spur growth. Pelosi, who spoke for more than 8 hours yesterday in opposition to the deal, noted in her letter that although Democrats are in the minority, quote, House Democrats have a voice here and we must be heard, end quote. Meanwhile, Kentucky Republican Rand Paul is the reason that there has been no vote in the Senate yet. He's refusing to grant consent to take a vote on the spending package. That is according to other senators. House Speaker Paul Ryan today promised that immigration would be addressed once the government is funded.
I know that there is a real commitment to solving the DACA challenge in both political parties. That's a commitment that I share. To anyone who doubts my intention to solve this problem and bring up a DACA and immigration reform bill, do not. We will bring a solution to the floor, one that the president will sign.
Speaker Ryan would not give specifics on any terms he thinks might be agreed to in any future immigration bill. Today is White House Staff Secretary Rob Porter's last day on the job. Porter said he would resign yesterday after reports surfaced that he had emotionally and physically abused his ex-wives. People familiar with the matter say senior White House aides knew about the domestic violence allegations before. Porter has denied the claims. The United States says Syrian President Bashar al-Assad's attacks against civilians using chemical weapons and bombings, quote, must stop now. State Department spokeswoman Heather Nauert says there have been reports of new attacks in the past 48 hours, killing dozens of civilians. Meantime, Syrian state-run media said today that a rare U.S. strike on pro-government troops in eastern Syria is part of a new effort, quote, to support terrorism. A U.S. military official said the assault, which killed about 100 fighters, was in self-defense, citing an attack on allied forces elsewhere. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Mark Crumpton. This is Bloomberg. Julia?
Thank you very much, Mark. Right, let's give you another cross-check on the markets right now. I'm showing you the Dow and the S&P 500. The Dow currently down some 2.7%. Actually, we've just traded through the lows of the session, so we are now trading around the lows of the session. 24,210, in fact, was the earlier low, so we're just above it.
Revisiting those levels.
Exactly, just revisiting the lows of the session, so we will continue to watch that as well. The VIX Volatility Index also higher on the session right now. Let's just take a look at what's going on as far as the broader markets are concerned.
Yeah, because we see the DAX falling, and this is the global picture here. You can see the bright red in the United States, Mexico. That indicates how steep the decline is. If it's a duller red, the losses are not as dramatic. dramatic. There were some spots of green. For instance, India, Japan overnight. Australia also did close higher, but the selling resumed in the United States after a move lower into yesterday's close in New York.
Yeah, absolutely. And the European markets most definitely took their cue from the weakness that came later on in the US session as well. And as you can see, the close for the European market,
bright red across the continent.
Very weak. Yeah, down 2.6%. We were showing you there for the German markets. Plenty more to come from us, including updates on these markets. From New York, this is Bloomberg. Markets. I'm Julia Chatterley.
And I'm Scarlett Fu. It's time now for the Bloomberg Business Flash. Look at some of the biggest business stories in the news right now. The maker of parkas that cost as much as $1,500, Canada Goose, falling by the most since it went public last year. The company announced better than expected results, but it declined to give an annual forecast and named a new CFO. UBS Group's investment bank allocated the biggest bonuses to its top performers and younger employees, millennials, as competition from other industries continues to heat up. This strategy is similar with rivals in the sector. Poor Gen X.
Yes.
And that is your Business Flash update.
Right, let's bring it back to the markets now. We've got US stocks trading around session lows. Cameron Kreis, Bloomberg's global macro strategist, joins us on set. Great to have you with us.
Always a pleasure.
Tom Lee of Fundstrat just said this is an extremely healthy correction. Thoughts?
Yeah, I think that's probably right. I feel I'm going to date myself here. There was a movie from the 70s called Animal House. At the end, a very young Kevin Bacon was in the streets as the crowd was rioting, saying, "Remain calm, all is well." And I feel a bit like that. I think a lot of strategists must feel like that because clearly, in the short run, you know, that sort of call that, hey, everything's still okay, is getting a bit run over by the price action. But ultimately, you're not supposed to go up 6% in a month.
You can't have it both ways either. You can't complain on the way up and then complain on the way down.
I mean, there's no such thing as volatility that's confined to one side of the return distribution.
Yes.
You get a lot of vol on the way up in terms of the magnitude of the move. So, you know what? This is a little bit of payback. And guess what? It's always faster on the downside. You know, the old saying, you go up the escalator and down the elevator.
Yeah, we look at the numbers, and it's startling to see a loss of 655 points in the Dow. But then you look at the percentage move, 2.6%. 6%. Yes, it's steep considering what we've had recently since the start of 2017. But a 1% move today is not the same as a 1% move, say, last year or 3 years ago.
Yeah, well, as a public service, I would say, quoting Dow points, I think it makes it sound worse than it is. I'm old enough to remember when the Dow was 2,000. So when just mentally, when you hear 600 points, it feels like the world's coming to an end.
We need Kevin Bacon.
Yeah, the world's coming to an end. But as you say, in percentage terms, it's relatively small. And ultimately, if you're managing a portfolio, whether you're an individual investor or an institutional investor, it's the percentage return that matters. But the fact is that the volatility climate has changed. And so a move that would have seemed extraordinary, say last October, is now sort of commonplace.
Maybe this is a run-of-the-mill garden variety pullback, then.
One can only hope so.
Cameron Kreis, Bloomberg macro strategist, thank you so much. Options Insight is next. This is Bloomberg.
Todos los personajes pasan alguna vez por la silla roja. La silla roja. Domingo, 9 de la noche. Retransmisión, lunes, 9:30 de la noche. Porque reconoces lo importante, el Financiero Bloomberg.
This is Bloomberg Markets. I'm Julia Chatterley.
And I'm Scarlett Fu. It's time now for Options Insight with Julie Hyman.
Thanks so much, Scarlett and Julia. And joining me today for Options Insight is Steve Sosnick. He's Chief Options Strategist at Interactive Brokers. Steve, you were here the other day following the big sell-off that seemed to be volatility exacerbated, if not induced. What do you make of the action that we've seen since, and particularly today as we see stocks selling off pretty sharply again?
Well, I think what's happened a couple times is people have been failed by the dip attempts. And I think buy the dip is a strategy that worked so well, it's going to take a while to put a stake through its heart or for it to start working again. And I think that's what we've seen a couple times, because people may have felt they missed the buy the dip moment on Tuesday, and then you'll see a couple different times. This morning when I started checking the futures, they were down 15. By the time I get in the office, they're up 15. And so obviously there's people still trying to catch these knives.
But what pulls it back down again? Because we had the short vol blow up, right? That seems to be done, though. So what now is sort of filtering through the market?
I'm going to argue it's not really done, because these things take time, and it's hard to have such a dislocating move without leaving all kinds of wreckage around that you're not really expecting. And that really becomes the problem in these things, where it's too hard to just sort of say, all right, well, we're done. We had our miserable 2 days, let's move on. There's different things out there. Yesterday a friend of mine was complaining that he got margin called away on all kinds of stuff over the last few days. These things take time to work themselves out, and they also resolve themselves in very strange ways. And so it's a little unrealistic to say, okay, boom, we hit our magic down 10% and let's move on from here.
Right. Right. Just quickly, I want to show the VIX futures curve. If you take a look at the Bloomberg, we have a picture of that. And that basically shows right now it's pricing in high expectations for the VIX, and then that falls down.
Yep.
Usually this curve goes in the other direction, right? So what is it telling us?
Well, this is you know, the VIX futures are in backwardation, and that's usually that's the market's way of saying, wow, things are very much in crisis now. We expect them to sort of resolve themselves. You'll see that the longer term is still anchored around the 20 level, which is, I guess, back to the historical norm. Right. That seemed obscene when we were sort of trading at 9s and 10s and 11s. Yeah. Now, when we're at 30s and stuff like that, well, all of a sudden 20 would seem
more reassuring.
Yes,
I guess.
Exactly.
Let's get to your trade or a trade that you're potentially looking at, because with dislocations come opportunities, of course. And you're looking at high yield, interestingly, HYG. Tell us what you're seeing there.
Well, what I've seen there is actually that hasn't fallen off nearly as much as one would expect, considering what you see in the stock market. Remember, high yield is sort of one step above equity on the capital food chain, as it were. And you've seen the treasuries really come off very hard, and yet the high yield, as measured by HYG, is off a few points, but really not a substantial loss. If you compare it to IEI, which has a similar duration of treasuries, they're both BlackRock ETFs. IEI has fallen much more sharply than HYG. So I'm thinking, all right, if HYG is the next shoe to drop, how do we profit from it? Its vols have gone up tremendously, so I thought about puts, but the puts are actually pretty expensive. So next thing to do is sell a call spread. You sell an at-money option. You try to reap in the vol, and then if you buy an out-of-the-money call just in case you're wrong.
Gotcha. So this is saying that perhaps HYG will be the next shoe to drop. Could get caught in this.
I find it hard to believe that this is the one thing that hasn't really gotten hit yet.
All right, we'll be watching it. Steve Sosnick, thanks so much. Great to see you of Interactive Brokers. Julia.
Thanks very much, Julie. We are still trading around session lows here for the US majors. We have 30 minutes until the US markets close, but it's not just a United States issue. Pressure globally, as this chart shows you. WM go.
You have the United States in bright red declining. Mexico also lower as well.
This is news, but not as you know it. This is TikTok by Bloomberg.
La evaluación del cierre de la jornada de negocios con el equipo editorial del Financiero. Susana Sáenz, Jonathan Ruiz y Abraham González. Análisis, entrevistas, reportajes. Mesa Central, lunes a viernes, 6 de la tarde. Porque reconoces lo importante, el Financiero Bloomberg.
¿Qué va a hacer el INE en caso de que el escenario sea una contienda muy cerrada, en donde no estén en posibilidad de declarar un ganador?
El INE va a dar los resultados del conteo rápido, sean cuales sean.
Hay quienes piensan que el INE está rebasado.
No estamos rebasados.
El INE, digamos, ¿ha notado alguna injerencia?
Ningún indicio ni ningún elemento en ese sentido.
Porque reconoces lo importante, el Financiero Bloomberg.
quickly pass a 2-year spending bill that would avert a government shutdown tonight, the chances of it making past the House are less clear after Democratic leader Nancy Pelosi yesterday objected to the bill's lack of immigration language during an 8-hour speech. House Speaker Paul Ryan today promised the issue would be addressed once the government is funded.
I know that there is a real commitment to solving the DACA challenge in both political parties. That's a commitment that I share. To anyone who doubts my intention to solve this problem and bring up a DACA and immigration reform bill, do not. We will bring a solution to the floor, one that the president will sign.
Speaker Ryan would not give specifics on any terms he thinks might be agreed to in any future immigration bill. President Trump has nominated California tax attorney Charles Rettig to lead the Internal Revenue Service as it puts his Republican tax overhaul into practice. Rettig would also have an even more sensitive job overseeing an audit of the president's returns. Mr. Trump departed from roughly 40 years of tradition for presidential candidates by refusing to release his tax returns during the 2016 campaign. Two former White House chiefs of staff say President Trump's Twitter habit has been, quote, distracting at best and destructive at worst. And if he were their boss, they would tell him to stop. That's according to the Washington Post. Josh Bolton, who was chief of staff to President George W. Bush, calls Mr. Trump's tweets, quote, political gasoline. Dennis McDonough, who was President Obama's chief of staff, says the president's tweets have the ability to, quote, walk back a lot of hard-fought progress. Israeli Prime Minister Benjamin Netanyahu is brushing aside accusations of wrongdoing, which are the subject of several corruption probes. Israeli media have said the investigations are likely to result in indictments. But in a video posted on his Facebook page today, the Prime Minister insisted the probes will find nothing. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Mark Crumpton. This is Bloomberg.
All right, U.S. stocks are once again approaching their session lows on higher than average trading volume, and we still have 30 minutes left to go before the trading session ends. Let's go now to Julie Hyman for more. Jules?
So just to give you a snapshot of the market here are the major averages, and indeed they are trading at the lows of the session. We also have the VIX up here, which is now at about 32. Remember, the long-term average is right around 19.5, 20 for the VIX. So still at elevated levels here in the wake of the short volatility trade blow up on Monday. And we see the Dow, the S&P, and the NASDAQ all falling by more than 2% at this point. We also are seeing it as a pretty broad-based sell-off. Now, the action during the day, if you're a bull, has not been very favorable in a number of different ways. First of all, you have the fact that stocks continue to try to make sort of attempts at gaining and then don't quite make it there. In fact, the S&P 500 was in the green earlier, just at the beginning of the session, before then falling lower. We saw several sort of attempts to try to rally, which have not been successful as stocks once again fall to near the lows of the session. Another thing, if you're a bull, that's not necessarily positive is that these sell-offs keep coming, right? So here's a look at the one-day percentage change for the S&P 500. All of last year, there were only 4 occasions on which the S&P fell 1%. Here we are in 2018. It's already happened 4 times in just not even a month and a half into this new year. So, and the falls, of course, have not just been 1%. They've been considerably steeper than that on most of the various occasions. There's also the question of volume. As Scarlett mentioned, here's AVAT on the Bloomberg. And it's interesting because earlier this morning, when there was sort of not as much price action on the S&P 500, in other words, when the declines were not as steep, volume was actually running below the 20-day average. And then we hit just after 11 o'clock when the selling had accelerated. That's when volume took off in more decided fashion. And now we're seeing volume at about 25% above the 20-day average. This is for the S&P 500 in particular. So this is another sign, again, if you're a bull, that it's not necessarily doesn't presage necessarily less selling, although it could be the so-called exhaustion or capitulation that some investors have been looking for. And then finally, as we look at today's session, I'm just going to refresh here as we're looking because I want to get the latest numbers. There are only 39 stocks in the S&P 500 at this moment that are trading higher. Some of the biggest drags, and this is in index point terms, not percentage point terms. In other words, the stocks that are both the heaviest weights as well as falling today. So you've got Microsoft, Microsoft, Amazon, Facebook. So a lot of the big tech companies are selling off. And then you have the financials as well. Berkshire's on here again. JP Morgan, Bank of America also selling off. So that's where we're seeing the laggards within large cap tech, within financials. There are still some stocks that are rising here, even in this environment. So it's not as broad a sell-off as we have seen on prior occasions this week, but still only 39 stocks in the S&P higher. Julia?
Thanks for some great perspective there, Julie. Right, let's discuss this in a bit further detail. As Julie mentioned, we are trading at session lows here for the US majors. Joining us is Mike Reagan of Bloomberg Markets Live. Mike, is there any sign, as far as you're concerned, of exhaustion point with the choppiness and with the selling that we're seeing across markets here?
Not quite yet. I mean, I think when these real big spasms of selling occur, there's kind of this pattern that happens. You get a real sharp rebound, then you might go back and sort of test those lows again, and the market kind of wants to see where the buy offers are. So the intraday low from Tuesday, especially I think in the futures, will be an interesting level. If we break through that, I think a lot of people are going to get nervous. Obviously, it's being called a flash crash on Monday, which I think is true. But to me, there's a real big distinction to be made about this crash on Monday compared to, say, the 2010 crash. That particular one exposed a lot of flaws in market structure. You know, market makers had these stub quotes that caused a lot of big stocks to go to 1 penny. And, you know, obviously some flaws in the structure of the market that I think have somewhat been addressed since then. I'm not sure this one had anything to do with market structure. It's clear someone was selling big, maybe a bunch of different strategies at once. You know, I don't think it's productive to really point fingers at this one or that one because it's not necessarily a flaw in the structure that caused it. We don't want to sort of outlaw these program tradings that sell at certain times of pickups and volatility.
As you say, earlier in the week, there was a lot of finger pointing at the various VIX-related notes, whether on the long side or the downside, in ways that perhaps imbalances there may have exacerbated the selling. Are people still talking about that, or is that sort of like, that's Monday's news, and now we're on to something new?
Yeah, there's so much. So when you look at those exchange-traded VIX products, you know, Chris Nagy on the stocks team had a great metaphor. He said, they're like the visible tip of the iceberg of this enormous short vol trade that exists that we can't necessarily see through vehicles like that. Yeah. So I think they are sort of the part of it that you can see. And there was likely a lot of other options and gamma-related selling that we don't necessarily can't point a finger at directly. Right. How long that takes to shake out, I mean, it very well could still be part of what's going on now. But the way I look at it is, you know, you look at the market last week before the big freak out on Monday. You know, it was pretty volatile relative to what we've seen going into that. So you have this big drop on Friday after the wage data was hotter than expected. And you got a lot of people, not just, you know, sophisticated computer hedge fund type of traders, but regular people sitting there thinking about that all weekend. And then, you know, Monday, who knows how many people made decisions over the weekend that affected what we saw on Monday.
Yeah, someone else has observed that the big sell-offs tend to come on Monday when people have time to reflect on really what the data indicated. Right. Speaking of the data, everyone keeps coming back to this idea that the economy is fundamentally sound, everything's going well, it's not much different than it was, say, a week ago or a month ago. And we know that a week ago, a month ago, people were buying on the dips. Where's the buying on the dips now?
Good question. Yeah, it's a great question, and another good stocks team story out about that today. Yeah, obviously, I mean, the fundamentals look great. You know, all sort of indicators of recession just aren't there. That said, I mean, you have to sort of second guess that notion a little bit when you see this continued weakness day after day. You know, to get back to that short vol trade, I mean, you can step back. My knee-jerk reaction would be to step back and say, that has nothing to do with fundamentals. Once that clears out, it's going to be back to the record highs again. But I feel like, you know, there was probably a guy sitting here in 2007 saying, what do mortgage bonds have to do with the stock market? You know, they're completely unrelated. So I'm a little reluctant to sort of ring that bell right now.
I saw a quote today saying fear of missing out sentiment has turned into fear of washing out sentiment. And why would you be buying on dips right now if you could buy on a lower dip, ultimately at a better price at this point? Is there anything that surprises you ultimately in what we're seeing. And I'm not just talking about equities here, I'm talking about asset prices in general, particularly given all the concerns that people were voicing about the steep run-up in risk assets that we'd seen, particularly in 2018 to start the year.
Yeah, the surprising thing to me, and possibly one of the more alarming things, is that this huge volatility in the stock market has not caused a big rush into treasuries. And we saw these two auctions this week where people were not buying with both fists like you would expect in this type of equity environment. So that's, keeping rates higher, which is very much what started this whole thing in the first place.
I just want to mention that with about 21 minutes ago in trading, we are looking at indexes at their session lows right now. In terms of percentage terms, for the S&P 500, that's down 2.7%. For the Dow, it's off by 3.1%.
Thanks, Scarlett. Why aren't we seeing people rushing in to buy treasuries here, as you say?
Great question.
It's a great question. I wish I knew, but I think clearly, still that way. You go back to that wage data. You go back to the idea that the deficit is just getting blown up at a time when central banks are stepping away, and the tendency is to think that rates are going to go up.
It's the wrong trade to be in at that point if you do think rates are going to go up. Finally, the dollar looks attractive for a while.
Right, absolutely. And, also not the best news for the stock market either.
No,
at this
exactly.
point. Right.
Wait for the washout. Well, we shall see. Thanks to Mike Regan of Bloomberg Markets Live, MLive Go, right, Mike?
Yeah, that's right.
MLive Go. All right, coming up, Monday's implosion of the XIV, we were just talking about this, raising lots of questions about the other exchange-traded products that also use derivatives. What's next, everyone's asking. This is Bloomberg. volatility hangover may not be over yet. This week's dramatic plunge of the $1.9 billion exchange-traded note, XIV, is raising concerns that other problem children are lurking. Joining us now is Rachel Evans, who covers ETFs for Bloomberg News. And before we even get to other problem children, what's noteworthy here is that XIV is